it's worth considering like that you don't want to try and just push yourself to markets that you don't understand just for the sake of exposure or, you know, risk management and things like that, and trying to diversify too much. If it's at the cost of you investing in what you understand and what you know in, then I don't think it's worth worth spending too much time on that kind of thing, because that's what investing is at the end of the day. It's all about compounding. And, you know, there are going to be years where you potentially lose money. There's certainly going to be months where you lose money and weeks where you lose money. So, you know, you have to be mentally prepared for that, even if you're investing in, you know, a fund.
Hi guys, so we are in for a treat today. We have, in my opinion, one of the greatest traders and most popular traders in this era. We have Jaynemesis, one of the largest AUMs also in the popular investing program. Jay, how are you? How is everything in England?
Yeah, I'm good. Lockdown is in a bit of a limbo at the moment, so we're not sure if we're in lockdown or if we're not. Apart from that, you know, it's okay. I work from home, so everything's fine for me, I guess.
And I think that's one of the biggest advantages of people who are investing, or a lot of people who just stay at home. It really doesn't affect their jobs, their businesses, or their, I think, way of making money as well. You are one of the best popular investors in the planet. And I'll go straight to it. What makes you so good at trading?
I think it's a combination of a little bit of experience, a little bit of luck to begin with, and then basically just kind of finding my niche, right? And finding the method that works for me in terms of strategy. And you know, I'm one of those people that pays a lot of attention to the product of companies, and kind of, you know, investigates, you know, how things work and what the competition is and things like that. And I think in the era of growth investing, you know, it's kind of become more important to understand subscription models and things like that. So I think that's where my strength is.
Okay, but do people know how long have you been investing and what your how many years have you been doing this? Because I saw it from your profile. You started with different jobs that are not connected to what you're doing right now, from a professional gamer to a PC technician to a logistics coordinator. What led you to all of this?
Yeah, so I was interested in investing from the age of about 13. I remember distinctly asking my parents if they could get Sky TV in the UK so that I could watch Bloomberg at the age of 13 when everyone else was watching. Yeah, when everyone else was watching, you know, football and cartoons and whatever, my brothers, I was asking if I could watch Bloomberg and try and learn more about, you know, the economy and finance and stock markets and how it all works. So yeah, I started investing when I was 19 with basically all of the savings that I had at the time, which was about £2,000.
Okay.
And yeah, the rest is history. I joined Etoro about 7 years ago now, and that's where I've been trading ever since.
Okay, so you're 31 now. You started Etoro 7 years, so that's 24. From 9 to 24, were there a lot of mistakes along the way, and how did you grow and evolve in that process? Did you start specifically into stocks, or I've seen in your profile you've also been trading cryptocurrencies as well? How did it go when you started?
I think really the trend with me has always been technology, especially to begin with. You know, that's what I was comfortable with. I was a gamer. I knew about all of the, you know, coolest, nerdiest products coming out. And so that's where I started investing, you know, in the chip market, in smartphones. I was investing in companies like Qualcomm and ARM Holdings, who just got purchased by NVIDIA recently. I was investing in them back when they were listed on the London exchanges back in 2010, when smartphones were still pretty new. Yeah, I think that's really, you know, where I kind of started. Cryptocurrencies, I found Bitcoin in late 2012 and invested in 2013. Yeah, yeah. I mean, in my experience, you know, you've got to be pretty lucky to have found it before. So to some extent, that was like, so many people ask me where I found it and how I found it, and I genuinely cannot remember at all. But one thing I do remember, and you might remember this as well, actually, is there was a StarCraft 2 show match tournament that was hosted with, I think it was 10 Bitcoins as the prize. It was streamed on, I think it was Justin TV at the time or something like that, before Twitch, was really a big thing. And I distinctly remember that, and I actually contacted the 2 players from it recently to see if they still had the Bitcoin, and unfortunately they sold it as soon as they won it. So that's a fun story.
It had a low conversion at that point, but that was so interesting. If they held on to it, it would have been a large amount of money.
Yeah.
Now I'm so interested about this. When it comes to trading and investing, you said that you do fundamentals and you do technicals. How do you marry the two? And for example, you trade US markets, there's thousands of stocks out there. How do you use fundamentals and technicals to weave through that?
In terms of looking what to invest in, generally speaking, it's going to be a company that I've stumbled across in real life somewhere, right? So, for example, one company I've been watching recently a little bit is ABBN. And they basically build infrastructure for electric vehicles and things like that, and charging infrastructure. They do a lot of other stuff besides that, a lot of different electrical work, but that's how I stumbled across them, because I saw them advertising on Formula E, but in terms of like kind of narrowing that down and how that works, essentially it's a lot of it is just the really, really basic quick things that you can look at, like the price to earnings ratio, how much debt they have. You can look at discounted cash flow and things like that, but I don't tend to use that quite so much unless I'm really digging into something. But for really quick things, I find things like that really useful.
That's so interesting. You mentioned PE ratio, but when I was looking at your portfolio, there were a lot of tech stocks there, and sometimes for tech stocks, PE ratios tend to be off the roof in terms of valuations. That's
the difficult thing investing in tech, right? I mean, I think currently Shopify has got a PE ratio of about 500. So read into that what you will. It did used to be 1,000 though, so it's difficult. I think you've got to look at the peers. For example, the solar industry is an area I look at quite a lot, and they're a bit more reasonable there. They're generally in like the 20s. And again, you can kind of compare between different companies, because there's so many companies that do essentially the same thing in the solar industry. They're either making panels or they're installing panels. So you can compare pretty nicely between different companies that way. The other thing that I think is most important is to consider the growth aspect, right? Because that's what really makes that PE number skyrocket in growth stocks is people's vision for 5 years in the future. So you've got to kind of play a few thought experiments out in your head and figure out what are these guys going to do in the future, what markets are they expanding into, what new products are coming, what's their vision. So that's the bit that's a bit more tricky to do. And that's the bit that you kind of start to really dig into once you've seen a reasonable PE ratio compared to their peers and things like that. That's when you start to dig into like what is this company doing.
Are you the type of person who wants to look into a stock, but even if it looks so interesting, growth and PE wise, but if the technicals is saying there's no movement yet, it's consolidating, there's not much volume, are you the person who comes in before everyone else comes in, or do you want to come in when it starts moving already?
A bit of both, really. Sometimes, so stocks that I trade a lot, I'll keep an eye on their technicals, and if I think there is a breakout about to happen or something, if the I'll be looking more at like hourly, 4-hour charts in that sort of situation. Whereas when I'm finding new stocks for the first time, I'm looking at daily and weekly charts, sometimes even monthly, and I don't care if the price is still falling. If I'm confident in where they're going to be in a year's time, I'll start building my position then.
But when you start entering into something that you have not invested yet, it's your first time investment into this, do you tranche it, and if you're tranching it, is there a specific technique percentage that you would do that not more than 20% for the first one, or any specific guideline that you follow?
Yeah, so generally I run a pretty diversified portfolio, and for the past 6 years or so, I've essentially run it with every single trade for me as 1% of the portfolio. And that just makes it much easier to kind of manage risk. And so if I decide that, I want somewhere in the region of 5 to 10% exposure to a company, it's very unlikely that I'm going to open all of that 5% in one day, right? I'm going to spread that out over the course of maybe a few weeks or a few months potentially. in 5 or 6 different trades. So that's the way I approach it. Honestly, that was more born out of eToro and how eToro works with copiers. Copiers, if the minimum you can copy with on eToro is $200, and when you're copying it, it's mirroring your trades exactly. So that means that if I have 1% positions, then each of those trades is worth $2. So if I went any lower than that, then it would hit the minimum trade size for eToro. So that's entirely why I started doing that. Really, it was because of how eToro works. But I actually really like it as a kind of easy, clean way of managing your portfolio. Everything is kind of round numbers and easy to deal with.
If I'm a person trading my own portfolio and say my portfolio is $100,000, how would you suggest that they chop it up? And this, when I say 100,000, this is purely for investing. They have other cash elsewhere.
So generally speaking, I would say that you want to try and be exposed to at least 5 different markets, and also it's important to consider geography. So, I try very hard to make sure that I'm investing in companies that are, even though they're all tech stocks, they're all kind of diversified within that industry. So, for example, you've got companies like Qualcomm and stuff that are doing things with 5G, or you could go with solar companies, you could go with electric vehicle companies. I think that's the way that I look at it. Things like Microsoft and stuff for cloud, and then, as I said, trying to diversify that geographically. So looking at some of the good Chinese stocks, some of the stocks out of Europe, which is a bit harder for tech actually. Asia and the US is where most of them are. But yeah, that's the way I try and look at it.
So I'm so curious about this. I'm based in Manila. I'm not sure if you've looked at the Philippine Stock Exchange. It's a very, very small market compared to Hong Kong and compared to Japan.
Yeah.
But if you are gonna analyze a market that you have not known, what would you look at first? And I'm speaking particularly for the Philippines. So if you're gonna enter something or like Vietnam or Indonesia.
Yeah, it's difficult. I mean, there are a few companies I follow from the Taiwanese market. That's probably one of the smallest Asian markets that I follow. It's really difficult to say. I mean, for me, as I said, the main way that I find companies is through the product, and through it, experiencing it in real life. So it's less likely that I'm going to bump into something from exchanges like the Philippines. The reason that I found the ones from Taiwan is because there are a lot of gaming companies based on the Taiwanese stock market. So
makes sense.
Yeah, I think in some ways it's worth considering like that. You don't want to try and just push yourself to markets that you don't understand just for the sake of exposure or risk management and things like that, and trying to diversify too much. If it's at the cost of you investing in what you understand and what you know in, then I don't think it's worth spending too much time on that kind of thing.
How big of a bias do you put technicals and fundamentals? Say there's already a buy signal for technicals, but for example, a stock breaks out. When a stock breaks out, the price is normally higher, so PE ratio wise, it's even more expensive. How do you weigh things in terms of what's more important for you?
Yeah, so generally speaking, I won't invest in anything that I don't understand like the long-term vision for, as pretty much a hard rule. So if I'm seeing all sorts of interesting stuff going on Intel right now in terms of technicals, and I'm thinking, I should maybe consider some trades on Intel, maybe some day trading even. Generally speaking, I won't go for it because I'm not bullish on Intel at the moment. I'm bearish on Intel, and until that changes from a fundamental perspective, and until I'm confident that they're ready to start the rebound, I'm not going to risk putting my money in it because there's always the chance that there's going to be a headline while you're in the middle of that trade that just totally ruins your exit strategy. So I think it's important to always consider. I mean, there's so many opportunities in the market, right? You don't need to go and chase them. You just need to wait for them to come to you and wait for them to come into your territory, the stocks that you understand.
Looking at the earnings and the business itself, while all of that was happening, does that mean you also hold a stock for a relatively longer period of time? What's the longest that you've held it for trading?
My average trade length, I think, is around about 3 or 4 weeks at the moment, but that's primarily because I like to cycle out of positions and basically take some profits off the table and then reopen the position. So I do that quite a bit. In terms of like how long I'm actually trading that company using that method, it's usually a minimum of like 6 months up to 3 or 4 years. Some stocks like AMD, I've just been consistently trading for the past 4 years, for example.
Okay.
So I've always had exposure to it. All I'm doing is kind of managing that and toggling it up and down and stuff according to risk and taking profits when it feels sensible to do so.
Is that part of your bias as a gamer as well? and Nvidia.
Yeah, I mean, as I said, it's things that I use in real life. I actually just built the PC that I'm speaking to you on now. Built it myself, and I used an AMD processor, and I used an NVIDIA graphics card. And I made those decisions because I looked at what Intel has to offer, and I looked at what AMD has to offer for graphics cards, and they're just not there. They're not even competitive at the moment. So, the thought of investing in Intel right now, I find incredibly scary.
Okay, that's so interesting. Now, since you're using charts and technicals also, you believe in a stock, you believe in its growth. From a technical perspective, it breaks down from the support. Do you hold? If you hold, how long do you hold onto it? Or do you also, you mentioned that if it's going down and you believe it's going to do better, you buy even when it's dropping. Is there a point that you cut loss as well?
Yeah, I mean, there has to be with everything, I think. If you don't, you're playing such a dangerous game. I think I'm trying to remember what the phrase is. It's essentially that the markets can stay irrational for longer than you can stay solvent, I believe is the phrase, right? So it doesn't matter how good your fundamental analysis is. And actually, AMD is a good example because I experienced this with AMD about 2 years ago, I think it is, when they were trading at about $10. And in my head, they were worth 20. At that moment in time, just like straight then, 100% higher. And it just refused to move out of this $8 to $10 range, and it was trading in that range for about 6 months to a year. And I had been buying more and more, thinking, it's got to go. But at some point, you have to take that risk back off again. And when I think it broke down from that before it ended up breaking up. And so I just took money out. It broke through below $8, and I just took about half of the position out. And just kept the rest, and then I was right, typically.
So I'm curious about that. When you said you took the position out, you cut. When you draw your support line, candlestick, at the moment it happens, you get out, or do you wait for more confirmation? Because a lot of traders struggle with that. When they draw a line, they use a moving average. When it goes below, they're not sure. I'll wait for 2 more candlesticks, and the second and the third ones are large ones, and they end up holding on to it.
Yeah, so I think it depends on a few factors, right? It depends on the size of the candlestick. If the candlestick is pretty small and it's just gone through it, absolutely wait for a few more candles, I think, because there are a lot of situations where it's testing that support, and it's a tough test, right? It's a battleground. And so you kind of just have to watch the volume and stuff, and see if you think it's actually going to stay below that support, or if there's a chance of it coming back up above it again. Because if it does that, then it's actually a really, really bullish sign as well, if it can hold that support after a big battle like that. So in some cases, I'll go down to like 10-minute candles or something, and essentially watch the battle play out, right? Like you can. This is the cool thing about charts, right? You can zoom in. You can expand those candles out and see what's going on at a more granular level, and look for more support, more moving averages in a smaller time frame. So I think that's a really important thing to do. It's so difficult to put it down to one thing, really, in terms of when it's gone wrong and when it's worked.
Do you have a favorite go-to moving average that you use? Because everyone's fighting. This is the best. Use a 50. Use a 20. Use the cross.
So I use a 21, a 50, and a 200. Those are what I use. And as I said, daily charts is probably the thing I'm looking at the most on average. I use 21 because I find it's just a little bit more lenient than 20. I was using 20 for a long time and finding that I was just slightly behind all of the moves. And I find that 21 tends to line up a bit better. And obviously 21 is exactly 3 weeks. So, that's the number I use. I actually stole that off someone else though, so don't give me credit for that.
Oh, that's interesting though, because a lot of people use 20 because they think it's 4 weeks, 5 days in a week, 5 times 4.
Yeah. And I think, well, it's 3 7-day periods, and I guess it stems from cryptocurrency, to be honest, because that's where I stole it from, and cryptocurrencies trade 7 days a week.
Yeah, makes sense.
I think that's where I got it from, and then I found that it worked pretty well on stocks as well, so I kept it.
So if you see a lot of people start using 21, they all copied you because it's mostly 20. It's mostly 20.
Yeah, I guess so.
When it comes to trading, people always talk about their gains, their wins. Is there a particular loss that you'll never forget, that because of that it also made you a better trader as well?
I mean, I think the entirety of 2018 is something I'll never forget. 2018.
Oh yeah, I saw that. Okay, yeah.
Yeah. So 2018 was by far my worst year of trading ever, and hopefully it stays that way. A lot of people actually, I find in trading and stuff, say like, the first year or the first 2 years is when you're going to wipe your account. You'll do it like once or twice. I've never wiped my account. And so 2018 was very scary because in 2018 I fell by I think it was 53.2%, something around there. It was essentially a perfect storm of conditions, right? So I was very heavily invested in cryptos. Cryptos had their worst ever year. It's when the bear market started, and every single cryptocurrency fell by 80% plus, and I had something around 40% exposure at the time, which is incredibly high, and I would never go that high again. So although I did good damage control on it, that still hurt a lot. The other thing is that what else happened in 2018 was obviously the trade war between the US and China, and there were a few sectors that were hit by that really hard. One of them was like the chip sector, and the other really big one for me was the renewable energy industry. And again, if I were to combine like my chips and my renewable energy stocks, that was probably another 25% of my portfolio. And then on top of that, it was actually a bearish year for the NASDAQ and for the S&P. It was a down year. So
while that was all happening on that year, what was going through your head? And here's the thing about trading, because everything is online. When your portfolio is up, you log in every time, you refresh that every time. But when your portfolio is down, no one wants to log in. What did you do?
I realized that I had to start taking hard losses, and that was very difficult, especially in cryptocurrency, because it's so much more volatile. When it comes to taking a loss in a stock, you may be thinking 5, 10, 15% stop loss kind of thing. If you're trading on a reasonably long time frame. In cryptocurrency, those numbers are more like 25, 30%. And so the point at which I was starting to cut them off was like 35, 40%. And I'm thinking, wow, that's a lot. That's a big loss to take. Yeah, that's a huge loss to commit to. Am I sure that this is the right thing? And that was really the most difficult thing. And of course, the other thing is the added pressure of my job, right? So I had about 16,000 people asking me what's going on at the same time, because that's what investing is at the end of the day. It's all about compounding. And there are going to be years where you potentially lose money. There's certainly going to be months where you lose money and weeks where you lose money. So you have to be mentally prepared for that, even if you're investing in a fund.
By the way, if you guys are watching this for the first time, we're with Jaynemesis. He's the most copied trader in eToro right now. While that was happening, did some of your copiers okay, it's down right now, I'll leave first, I'll come back when it's better, when things get better? Or there were ones that were loyal, will stick with you no matter what happens?
Yeah, there was a combination of the two. There was a real combination of the two. Some of them hated me. They really blamed me and were extremely angry about it. Others were much more sympathetic and kind of understood that they copied me because of what I invest in, and the sectors that I invest in are doing badly, and that is why I'm doing badly. And they understood that a little bit more. So I think over the course of the year following that, I lost around 60 or 70% of copiers over the year, and some of them unfortunately left in December, right before everything turned around and I had a really good year again. A lot of my copiers were actually investing in cryptocurrency themselves, and so some of them took their money out of copying me to go and buy more cryptocurrency because they thought it was cheap. So there was kind of an opportunity cost thing going on as well. So I think there's a lot of contributing factors, but the people who stuck with me are now like my loyal people that kind of shout from the rooftops and say, look, you're exactly right. They're now screaming and shouting, say, see, I told you he'd turn it around and all this sort of thing. So I think it's for me, it's really valuable because now I can, explain the situation to people, and people can see that I'm able to rebound from those sorts of things.
And I think this is something that's happening to everyone, regardless of where you live. That people always see the stock market as the lottery, that you're gonna make money quickly, easily, without doing anything. But it's not. It's really hard work. And the thing about that, especially for copy trading, in my opinion, the ones that make it big also are the ones that also could also give you possibility of more volatility when they get it wrong. And I think people need to understand that if you want someone that will give you lower returns, then those are the ones also that are relatively playing it safe. Do you still believe in long-term investing? That buy a stock with dividends, hold on to it, receive the dividends for the rest of your life?
It's not something I recommend to people at the start, right? So when you're 18 years old, you can afford to lose everything you've got, right? Because you've got another 50 years of your life to go and earn that back, and then some. So I think early on, it's really, really worthwhile pursuing growth stocks and pursuing slightly more risky investments. Try and do it diversified, right? So that you've got less chance of losing everything and more chance of, coming out a winner. I'd be kidding myself if I said that, dividends aren't an important part of a portfolio, especially as you get older. And you're looking more to protect your money rather than to grow it so much, and you're just looking for that kind of stable income. It is difficult because there is some research out there that says that dividend stocks, essentially the amount of money you get from a dividend is the amount of money you'll get if they didn't have a dividend just from the price going up. So I'm not sure how much I believe that. I currently have quite a lot of dividend stocks because of the current coronavirus.
What was the tipping point for you to actually say that, hey, I'm just gonna do trading, investing for a living? And for other people who would want to do that also, quit their day jobs and just do stocks?
For a really long time, I was approaching it from the mentality of I need to have a trading account of $150,000, and then from that point, I can live off the profits as long as I make an average profit of X, or thinking along those kind of lines. And then Etoro threw a spanner in the works by asking me to become a popular investor. And so now, this was back in 2015, 2016, I think. 2016 it would have been. On there, you earn money from copiers, essentially. You earn money from the amount of AUM you have. Etoro pays you. The copiers pay nothing at all. It's totally free. But that sped things up dramatically because all of a sudden, I had started to earn like this extra $1,000 a month from having, 1,000 odd people copying me. And that was enough basically to tip it over. At that point, I was like, well, that's like 80% of what I need as a bare minimum to live off. All I need to do is be profitable. At this point, I can take that gamble. And again, I felt like I was still young enough to take that gamble. I knew that I could still go and get a job if everything turned out badly, right? But I didn't want to lead that life of regret for not trying. So that's what I did. But again, this is why I think the growth thing is so important for when you're young as well, right? Is that you need to realistically, if you're going to live off dividends, or if you're going to live off, off just portfolio growth of, let's say, 20% a year, you're going to need a big balance in that account before you can do that. So the first few years, investing everything you can into that. Like, you don't need a Starbucks coffee. That's that $5 could be a share in, a share in a company, and that was my attitude from like the age of 15. I saved everything I had to start trading. And I stayed that way until I was about the age of 25 or so. And it was only then that I started to buy things from, like this house. It was only then that I started to live my life. So I guess that's it, really. Yeah.
Did you ever see that and envision that I'll be one of the most copied popular investor in the planet? Not just in England or Europe, you're the most copied in the planet. Was that ever an ambition?
No, absolutely not. I actually questioned why they even asked me. I didn't think I was that good. I guess looking back at it, I looked at my compound annual growth rate recently, and it's around 45%, and that's over 10 years of trading roughly. That is good. It's better than I thought it was.
You've beat a lot of hedge funds.
Yeah, I've beaten most hedge funds, I'm on track with some of the biggest investors out there. Obviously, I'm not 30 or 40 years in like some of them are, but I am 10 years in, and I think that's long enough to know that I am good at it. But yeah, I never expected it to explode the way it did. I still have to kind of pinch myself every day. Essentially, this is my dream job. I absolutely love what I do. I can't stop thinking about stocks and investing. It's hard to turn off. I imagine you're the same.
It's something that you love weekdays more than weekends, and that's what's so interesting about it. But you don't like holidays, because when there's a holiday, markets are closed as well. Here's a question. Speaking of growth, speaking of the direction, tech stocks had a run up. Then they've started to correct and consolidate a bit. Do you think it's over and we may see a longer consolidation? I'm just purely basing it on valuations, and people are saying it's close to .com era valuations already. What's your take on this?
So many people telling me about this as well. I was very strongly of the opinion that this current drop that we've just kind of experienced, that potentially is still ongoing. We might be bouncing, we might be flattening out a bit. I was very strongly of the opinion that this is just a correction, 10-15% correction. When I went through the earnings calls, and I listened to almost every single earnings call for almost every company that I invest in. So I even go back about a year actually. When I first invest, I go back and listen to like the last 4 quarters.
And some of those earning calls are not so exciting to
yes.
listen.
Yeah. I love listening to Tesla. That's all I can say. Elon Musk always brings entertainment, if nothing else. Yeah, some of them are very dry. But I listened to the earnings calls from the tech companies, and I felt like all of the valuations and all of the price movement was justified, especially given what's going on in the world right now. Home Depot was another one. Home Depot surged by they had their best quarter ever last quarter. And they absolutely flew, and everyone's like, I wasn't expecting this. I was watching Bloomberg, CNBC, all of the big talking guys were saying, this is insane. I've never seen this in 20 years of history. And I'm like, well, it was obvious. To me, it was obvious, that if everyone's stuck at home, they're probably going to want to improve their home because they're there all of the time.
That's true. Yeah.
And the other thing is, of course, that these stores are really big. They can very easily accommodate more people in the stores. It doesn't really affect them that much. All of these tech companies, it's a similar situation, right? It's obvious that people are going to start using Zoom. Yes, Zoom is, massively overhyped, but we are using it right now.
Yeah.
At the end of the day, we're still using it. And the fact that I'll Zoom you has become this thing that people say, in the same way that people say, I'll Google something, should tell you everything you need to know. They've won that war of branding. They are now synonymous with web calls. So you've got to kind of think about things like that when you're looking at this stuff. And I think most of the companies in the NASDAQ can justify their position. So,
and I like what you said for Home Depot. What people don't understand is people have money to travel that's not used. So if there's pent up at home, that money for travel is going to go somewhere.
If you're in lockdown, you're not going on your commute by train to the nearest city, which means you're not buying your coffee in the morning, you're not buying the newspaper, you're not wasting money on some random thing that you see on the way home to buy for your girlfriend or whatever. all of that money is suddenly in people's accounts, just sitting there. And as long as they still have their job, as long as they're able to work from home or they're still going to work, that money needs to be spent somewhere, right? Like they're not going to save it because most people just aren't that responsible. And you know, and in many ways I say that, right? But in many ways, things like improving your home, that is an investment. Yeah, I think people realize that, you know, that there's other things that they can spend their money on that they want and that will improve their lives, especially during this situation.
And if you're at home, there are things that you don't notice. Like, for example, we had this TV for quite some time because we're out most of the time. It didn't really matter. But when you're at home, it might be better to get a larger TV already because we wanted to experience something bigger because you're in your house most of the time. What's your advice to people who want to start at first trading on their own? What would you advise them to do? What should they study first? What should they look at first? If you would tell your 19-year-old self right now and give that person advice, what would it be?
Again, I got lucky in how I started, right? And the way I started, and the advice that I would still give, the number one thing would be invest in things that you're passionate about, right? I was a nerdy gamer who sat in my bedroom and I watched financial markets and I played games. And when I started investing, I invested in gaming companies. That was what I knew and what I understood. So, you know, it was even around game launches and things. I played the beta for World of Warcraft.
Whoa!
And I knew it would be big. And actually, you'll enjoy this as well. When StarCraft 2 was announced in South Korea, I bought Blizzard shares the same day. So, yeah, you know, it sounds crazy, but those things can make an impact. You've got to be a lot quicker these days because the news travels fast. But, you know, if you understand a company and what it's doing and what it's about and their values and what kind of products they're going to build in the future and how popular you think that's going to be based on your friends and what everyone around you is doing, then that's the way to do it.
Well said. And by the way, up until now, 90% of StarCraft is still Korea. It's still Koreans. It's still Koreans.
Yeah. They still beat me.
Why should they copy Jaynemesis?
There's a couple of reasons. I think the first thing is that I do try to be an ethical investor, right? So I can see climate change and everything like that happening. I consider worker conditions and stuff like that in how I value companies, and if I'm willing to invest in them. I'm not going to invest in a company that is literally, you know, working all of its staff to the bone and, you know, working them in horrible conditions. That just doesn't sit well with me, right? I'm in a position in life where I don't need to do that to make money. So that's number one, right? I will invest in things that I think are good for the planet and good for society. Number two, I mean, I'm high risk, right? If you like high risk, go for it. If you don't, then, you know, you need to be prepared for the fact that, you know, if you copy me, it's going to be a bumpy ride. That's always going to be the case, I think. So, you know, keep that in mind and diversify as well. Don't just copy me, right? Try trading and investing yourself. If you've got a hunch about a company, start researching it and go for it. That's my advice.
Okay, so I'll put Jaynemesis' profile below. If you want to see his track record, what he currently has, you can also check him out. But guys, there's a reason why he's one of the best and the greatest in the world. So this video will be in YouTube. So maybe 30, 40 years from now, they might even call you Peter Lynch, Ray Dalio, Warren Buffett. I don't know, but maybe along those lines, the modern era Warren Buffett. Yeah, you know.
I mean, I would love it, but I don't think it will happen. I don't think so.
Just one more thing. Speaking about eToro, it's massively bigger in Europe. It has grown there massively, but in Asia, it's something that's relatively new. The concept of CFDs is not something that's accepted as a broad. People think it's a bit scary. What's something that you can encourage people on with the concept of CFDs, and especially that you're trading something away from your normal country?
First of all, eToro isn't just CFDs, right? It uses CFDs mainly if you're using leverage and stuff now. So If you're copying me, everything that I trade is not CFD. You will be getting the underlying stock. And if eToro were to go bankrupt and disappear, your money is safe. They're very highly regulated in like 6 markets or something. They follow all sorts of guidance. They keep investor funds totally separate. So none of that should concern you. In terms of like investing outside your own country, you know, I started off investing in just the UK. And I just think that you kind of have to accept that there are cooler things in other countries. You know, the US has got so much cool stuff. China has got so much cool stuff. You know, and there are companies, you know, there's companies in Sweden that I like. There's a company in Denmark that I invest in at the moment. You just kind of have to go where the cool companies are.
And just to flip it, I think the mentality of people is, instead of spending that £5 on a Starbucks cup, why not just buy the Starbucks company? It's better invested, even though there might be a potential of volatility out there.
I 100% agree with that sentiment.
Thank you so much, Jaynemesis. It's such an honor to have you here and tickle your principles and strategies. But before we let you go, fast talk.
No.
Okay, love or money?
Love.
Short term, long term?
Long term.
EMA, SMA?
EMA.
Cut loss, hold?
Hold.
Warren Buffett, Ray Dalio?
Warren Buffett.
One time, big time win versus win small but repeatedly?
One time, big time.
Amazon, Google?
Amazon.
Bitcoin, Ethereum?
Bitcoin.
Large penthouse in the city or large mansion in the province?
City penthouse.
1 billion doing something that you don't love, or 100 million doing something that you love?
100 million doing something that you love.
Have a lot of money but fat, and having or rock solid abs but no money.
Rock solid abs but no money.
Okay, thank you so much, Jaynemesis. It's such an honor. Everything is in the description below if you want to know more about Jaynemesis. So thank you, and I hope you guys got a lot from this, and I hope this video helps you trade well, trade strong, trade smart. See you all again soon.